Today, we are diving deep into what I consider the single most crucial skill in the Australian property landscape: accurate valuation. In a market defined by uncertainty, where some sectors are still experiencing white-hot demand, while others are noticeably cooling off, getting the price right is the difference between building lasting wealth and financial frustration. If you're relying solely on the selling agent's guide price, you are playing a risky game, essentially navigating choppy waters with a blindfold on. That guide price, often deliberately low, could be a fishing price designed to draw you in. You might offer 5% or 10% above it and still fail to secure the property. You might even inflate your bid by 20% and watch the property slip away. But the opposite risk is just as dangerous. You negotiate fiercely, feeling smug that you knocked a few $1,000s off the asking price, only to discover later that you overpaid by 10% or even 20% compared to genuinely comparable sales in the area. This is the central challenge we face, and it's why understanding the underlying logic of property valuation is non-negotiable for serious buyers. For professionals like buyer's agents, valuation is not just a side task. It is the absolute core function of our service. Our primary mission is ensuring our clients acquire property that is genuinely value for money, and ideally, helping them snatch a bargain, securing a high-quality asset at a truly rational, low price, perhaps because the current market conditions are soft, or perhaps because the selling agent mishandled the campaign. But if you're a regular investor trying to navigate this landscape alone, lacking confidence in your valuation skills is a recipe for disaster. It leads to repeatedly missing out on properties 1, 2, 3, until frustration mounts, you abandon logic, bid recklessly high on something you don't even particularly love, and end up with terrible financial results and significant emotional stress for your entire family. The philosophical divide: price versus value. So, let's begin by clarifying what exactly we are trying to value. In real estate, we must differentiate between two concepts that are often conflated: price and value. Price is simply what we pay. It is the figure we write on the contract. Value is the intrinsic worth of the property. To set the appropriate price range for bidding, you must first understand the property's innate value. If you pay too much, you become what we call a sucker. You're the one who stood guard on the highest point, holding a financially over-leveraged asset. If you pay too little, someone else will submit a more reasonable offer and buy the property right out from under you. It is essential to recognize that in property markets, establishing value is fundamentally a comparative game. Your personal assessment of what the home is worth is irrelevant. The property's true value is dictated by the consensus, what the overwhelming majority of people in that specific area believe similar properties are worth. If you refuse to acknowledge these prevailing comparable prices, you simply won't buy the house. Another buyer, willing to meet the market, will take it. The tool we use to quantify this comparative value, the exact method bank valuers and experienced agents employ, is called CMA, comparable market analysis. CMA involves finding properties highly similar to your target property and using their recent sale prices to pinpoint the appropriate value band. The 4 fatal flaws of automated valuation tools. Before we dissect the CMA process, let's address a major pitfall that catches countless inexperienced buyers: blindly trusting automated valuation tools. Websites like realestate.com.au, also known as IEA, and domain.com.au, and previously some bank systems, offer automatic desktop valuations. These are based purely on big data analysis. While the algorithms are becoming more sophisticated, they rely primarily on surface-level, easily quantifiable features: the number of bedrooms, bathrooms, and car spaces, often factoring in the land area. The problem is that this big data is not detailed enough, and, critically, it suffers from several severe biases. Flaw 1. Severe data lag. The time warp. Automated valuations, even those pulled from sophisticated platforms, are often based on data that is months old. Think of property data as a slow-moving river. The most critical, first-hand data, the real pulse of the market, is the price agreed upon when a property goes under offer or under contract. This primary data sits exclusively with the selling agent for weeks or months. It takes a significant bureaucratic pipeline for this raw contract data to migrate from a selling agent's desk to state land registration bodies like Landgate, and then eventually aggregated into large paid databases like CoreLogic before finally feeding the ADV systems. This chain of custody means that the desktop valuation you see on a public website is suffering from a massive delay. In the best-case scenario, the data is 3 months behind. Often, it's 6 months behind. Imagine the volatility of the Australian market over 6 months in some regions. If you are analyzing a rapidly rising market using data from half a year ago, your ADV will significantly undervalue the property, ensuring you miss out. Conversely, if the market is rapidly adjusting or declining, the ADV will use artificially inflated historical data, leading you to overpay. Only in a completely flat, stable market is an ADV likely to be accurate. Flaw 2. The median price mirage. Another misleading aspect is the reliance on median price calculations. Median price is often the middlemost price in a set of transactions. Consider an area where 3 sales occurred. $1 million for 3-bedroom, $800,000 for 2-bedroom, and $500,000 for 1-bedroom. The median price would be $800,000. Now, imagine the next month, more larger homes sell. 3 3-bed homes at $1 million each, 1 2-bed at $800,000, and 1 1-bed at $500,000. The median price suddenly jumps to $1 million. Based on this calculation, the system might report that the area's price has shot up by 25% in a single month. This sharp increase is highly misleading. It reflects a change in the type of housing sold, not necessarily a true, underlying appreciation of value for every house type. Flaw 3. Inaccurate property classification. The ADVs rely heavily on the registered property type, but property classifications are not always straightforward or honest. Sometimes, agents deliberately label a townhouse or a villa as a standalone house to enhance its appeal and potential price. If an agent advertises a subdivided property as a house, and you compare it to genuinely independent houses, your valuation based on those comparisons will be skewed and potentially much too high. Buyers with limited property experience, especially first-time buyers, are prone to this error. You must ensure you are comparing like-for-like products. Flaw 4. Buyer budget screening, the limited utility. While ADVs are flawed for precise valuation, they are not entirely useless. Their best function is helping you rapidly screen a suburb based on your budget. If an ADV estimates the property is worth $1 million and your budget is $1.2 million, you know you likely have a chance in that area. However, if the ADV suggests a value of $2 million and your budget is only $1.5 million, you can quickly determine that the suburb is probably out of reach, saving you unnecessary time and effort. The gold standard, executing the comparable market analysis, known as CMA. Since big data is often insufficient, we must return to the robust, manual process of CMA. Real estate, unlike stocks, gold, or bonds, is not a fungible asset. One share of Apple stock is identical to the next, regardless of where you bought it. But in property, 2 houses on the same street can vary wildly. Even 2 identical apartments in the same building can have different values based purely on the floor level and the associated view. To conduct an effective CMA and think like a valuer, you must assess 3 fundamental pillars: land, building, and X factors. Pillar 1, the land component. The land is arguably the most essential and often the most subjective part of the valuation puzzle. Was the location truly worth? 1. Location and proximity asterisk. This goes beyond the suburb name. Is the land beachfront commanding a premium, or is it just one street back where the price might instantly halve? Is it ideally situated near local amenities, or is it adjacent to a busy main road, which usually results in a price penalty? 2. Size and shape asterisk. The sheer dimensions matter, but so does the configuration. 3. Topography, which means slope asterisk. The gradient of the land can dramatically influence usability and development costs. 4. Zoning and potential asterisk, what is the land designated for? The zoning determines its future potential, such as whether it can be subdivided or whether its density can be increased. These factors significantly influence the current land value. To accurately gauge land value, especially if vacant land has sold recently in the area, look at those sales. Furthermore, persistent interaction with local agents is necessary to understand the nuances of local sentiment regarding land characteristics. Pillar 2. The building component. Once the intrinsic land value is established, we look at the physical structure. This aspect is often easier to quantify, sometimes through a replacement cost calculation, which means how much it would cost to rebuild the structure today. 1. Age of materials asterisk, is it a brand new build, or does it require significant upkeep? Is it constructed of enduring materials like brick, or less durable materials like timber? 2. Size and layout asterisk, this covers the physical size and the configuration of rooms, such as bedrooms, bathrooms, car spaces. 3. Condition and renovation asterisk, has the property been recently renovated or refurbished? The quality and extent of these improvements are key value drivers. We must always look beyond the initial data point provided by the system. We once encountered a 3-bedroom, 2-bathroom property that the market valued significantly lower, perhaps $100,000 less, than comparable 4-bedroom homes. However, this specific 3-bedroom had 3 separate living areas. By making a simple internal structural change, converting one living area into a 4th bedroom, of course it required applying to the council for formal changes, we realized the property was, in essence, a 4-bedroom in potential value. Because the automatic valuation systems and the selling agent were fixated on the 3-bedroom label, the property was undervalued, allowing us to acquire a high-value asset at a comparatively low price. After the formal change and subsequent refinancing, the value quickly rose to match the 4-bedroom comps. This illustrates a profound point. A good valuation strategy requires digging beneath the statistics to understand the building's inherent flexibility and potential. Pillar 3. The X factors. Finally, we consider the intangible or unique elements, the X factors, that give a property a competitive edge. These factors are highly specific to the asset and cannot be derived from standard census data. Examples include asterisk exceptional views asterisk, an apartment located above a certain floor might command a massive premium if it offers an unparalleled view, such as the Sydney Opera House. Asterisk strategic position asterisk, the property might be situated on the highest point of the street, offering superior privacy or natural light. Asterisk future planning opportunities asterisk, the area might be earmarked for future planning schemes or increased density zoning, which significantly enhances the long-term development value. These unique characteristics must be weighed carefully, as they can lift the price bracket outside of traditional CMA boundaries. The valuation sandwich, a practical, free strategy. So, how does a typical buyer, especially one without expensive data subscriptions, apply this complex valuation logic? You must adopt the valuation sandwich approach. Using free public sources like the sold pages on Domain or IEA is essential. Look diligently at properties that have sold in the past 1 to 3 months. The goal is to bracket your target property's value. 1. The bottom bun asterisk, identify properties that are measurably slightly inferior to your target property. Perhaps they're smaller, on a busier road, or lack the level of renovation of your house. If this inferior property sold for $700,000, then your target property's value cannot logically fall below $700,000. 2. The top bun asterisk, identify properties that are measurably slightly superior to your target property. They might have an extra bathroom, better views, or a newer kitchen. If this superior property sold for $780,000, then your target property's value cannot logically exceed $780,000 by much. By using multiple strong data points to create this sandwich, you confidently establish a reasonable value bracket. In this example, $700,000 to $780,000. Your negotiation efforts then focus on determining where exactly within that range, closer to the bottom or the top your target property sits, based on the specific details of its building and X factors. The crucial role of agent communication. But remember the biggest flaw of automated data, the lag. Even the sold data is delayed, meaning you might be missing critical information about properties that have just gone under contract but haven't settled yet. These are the most current data points. Therefore, the final, indispensable step is active communication with local sales agents. You need to cultivate relationships and thoroughly understand the recent sales, especially those finalized within the last month or 3 months. You must push them for insight into the actual sale prices of properties currently under offer or under contract. This micro-level insight provides the most accurate, real-time market perspective, something no amount of reliance on automated data can achieve. Conclusion: navigating the emotional market cycle. Mastering property valuation empowers you to operate strategically, free from emotional bidding. In a current volatile climate, we see 2 common mistakes driven by emotional reactions rather than reasoned valuation. 1. Over-aggressive lowballing in a hot market asterisk. If you are buying in an area where prices are soaring rapidly, an excessive focus on haggling and cutting the price will ensure you waste countless good opportunities, leaving those assets for competing buyers who understood the true value. 2. Overpaying in a correction market asterisk. If you are buying in a cooling or adjusting market, failing to do your diligence means you could pay 10% or 20% more than the property is truly worth at that moment. You then become an accidental, high-level guard, potentially waiting years for the market to catch up to the inflated price you paid. Understanding valuation allows you to screen, select, and bid with confidence. It helps you avoid becoming the cautionary tale, the buyer who either missed every good asset or massively overpaid for a mediocre one. It allows you to quickly locate high-quality properties in desirable areas. If this level of deep dive research into land potential, building conversion value, and negotiating strategies sounds complex, and you're either a busy entrepreneur looking to convert corporate profits into stable, long-term assets, or simply a buyer serious about maximizing value, consider seeking professional help. We offer consulting services to guide you through this process. Alternatively, if you prefer to master these skills yourself, our educational programs detail the exact software and methodologies required for self-directed due diligence. Thank you for tuning in. Mastering the CMA is not just about crunching numbers. It's about mastering the underlying market psychology, ensuring you always know the difference between a high price and true value.